joins us. Let's take a conversation forward. Dinshaw, good morning. Thank you for joining us. Dinshaw, what has really changed the table? From massive small cap outperformance to a breathtaking move in large cap stocks led by Reliance and TCS. Why August has been such a breathtaking month, and so far September is also looking good? Because nothing has changed on the global front, nothing has changed on the earnings front, but the market positioning, if you are in the right stocks, it's absolutely breathtaking.
Morning, Nikunj, and thank you for calling in the show. And a very good morning to your viewers as well. Always a pleasure to be on your show, Nikunj. So the fact is, now if you look from the bottom, Nikunj, the market has done wonders. I mean, it's more than doubled, right? But now look at it over, say, a 3-year period. We're talking about a 15.5% growth in the market indices. I mean, Nifty 50 is what we're talking about. Even 5-year, if you stretch it, is again around 15 odd percent growth. Now, if you looked at the same figure, say pre-2007, that number was 46 odd percent for 3 years and 44% for 5 years. So you're not talking about a runaway market in any way. I mean, from the bottom, it looks runaway, but frankly, I mean, I think the market has done fairly decent amount of work. And you talked about why August and looked so good. I think it was a rub-off of two events, which actually two hurdles, which we thought in our minds were hurdles. One was the quarter numbers, and the second one was obviously the Jackson Hole Fed chair speech, where there was hardly any meeting. It was all I mean, there was no meeting actually. It was just a speech that was read out. So the fact was that now, even in the quarter numbers, only 3 sectors did well, and they were all large caps. I mean, they were commodities, there was financials, and export-oriented sectors. So the mid-cap and small cap took a backseat, rather more than mid-caps or small caps took a backseat. And as a result, you saw what you saw. And Jackson Hole was, I mean, too much water on the bridge, so I don't want to discuss that. It's like akin to riding a whitewater raft. You see these whitewaters and you wonder whether there's going to be a grade 3 or grade 4 kind of a ripple. But the fact is that it just turns out to be a excellent rather than anything else. And that's what happened in the last two. But going ahead, I think there are quite a few hurdles, further hurdles to be crossed. One obvious one is the waning monsoons. I think the Kharif crop is in place because it's more or less flat, but Rabi may become an issue given the reduced reservoir levels. I mean, the rains weren't that spatially distributed, I guess, and that's why North, Central, and I think West to an extent are impacted on the reservoir front. The second one is obviously the festive season, which is around the corner. Onam wasn't that great, and frankly, I mean, that can be explained because Kerala was going through a massive wave for COVID, but hopefully that won't stretch along. But indications are it's not looking too great either, the festive season. And the third one, which we've been quite apprehensive about, which we believe that the market never learns, is from history, which is your small caps. I mean, the way they've rallied, they've come to a premium to the large cap indices. Frankly, I mean, if you go into 15 years, look at the last 15 years history, every time there's a premium to the large cap, the small caps have corrected over a 12 to 24-month time period. And this is 4 times in the past 15 years which has happened, which we are very wary about. So that's our feel on what's happening in the market.
Nisha, if I selectively, and I'll be selective here, use the word festival season demand optimism, and that is what is fueling the market action, then why are auto stocks down? I mean, here's one sector where the whole festival demand should be felt the first, but on an average, now whether it is semiconductor or commodity prices, the bottom line here is that in a raging bull market, auto stocks are down 25 to 30% from the 52-week high ahead of the festival season.
Right. Nikunj, you hit the nail on the head. I think semiconductors is going to be a big issue here because, I mean, you've been reading about these global auto guys talking like yesterday, Toyota came out and said that we're looking only at CY23 when the semiconductors supply will stabilize. And that coincides with TSMC talking about a capacity expansion, which will take around 18 months to go on stream. So I think that's what they're taking a call on. But the fact is that even with the enhanced supply at N22 levels, I'm sure the demand also will be higher with 5G kicking in a big way by then. So I think this sector, the semiconductor problem will remain. Secondly, you talked about commodities. In fact, beginning of this month, Maruti took a price hike, but as brought out by analysts, it's still not covering. I mean, despite I think 4.5% odd on an average price hike that they've taken this year, it's still not able to cover all 50% of the commodity hike that they've seen. So that's another big overhang for them. And thirdly, I think the way the mix has changed, which is your SUVs and XUVs, which have come in a big way, the crossovers, that is, vehicles. I think that has created a bit of an issue with Maruti in particular, because they don't have too many SUV or crossover vehicle offerings. They're still in the entry level, where the market, the share of the entry level has gone down. I mean, that's what the reported numbers are. And the bigger one, the biggest bull in the China shop is EVs. I don't think the market is still discounting that fact. And we've been saying this all along, that on a longer term basis, EVs is going to be a reset for the whole industry. And if you don't pick up now, there's no way you can pick up in the future. And even if you do, a traditional IC guy gets into EV, the point is that there'll be more players in EVs, which has come through. And EVs is not about manufacturing; it's about consumer mindset, how you capture his mindset as such. So I think these are the problems that the auto industry is facing in particular, and that's why that industry will remain on an overhang, I suppose.
So, what is the best way to capture this festival season demand? Hotels, white goods?
No, so Nikunj, in fact, this is what we've been saying, that we don't see. I mean, the sound bites which are coming out are not that exciting for the festive season. I mean, they're looking at a steady kind of a growth. There's no one big upside which is going to be expected, because wave two anyway was hardly there, as in there was no pent up demand after wave two. So that more or less is done and dusted. Our feel is that now is a time to remain in large caps. I mean, forget about trying to find out ideas in the market. It'll be very selective run from here on, because the way the market has done, as you rightly pointed out, in fact, the year to date, the market is up 20% plus as such, so 4% or so. So in that way, you have to be very selective in your calls here. And we stick to our old and tested large caps in, say, private sector banks or NBFCs, or for that matter, the IT companies as such. So that way, so that's what we are sticking to and keeping it there.
Disha, just wanted to understand, what is it that you're making of this roaring rally that one is seeing in IT? You know, we were just drawing up data as to how the IT sector and most of its constituents have performed, not just in the month of August, but even month to date. Each time you think that IT is richly valued, these stocks move up even further.
Okay, so I remember my first interview with Nikunj, which was in, I think, Feb of this year, when I came on after a long time. And Nikunj asked me the same thing about IT. I mean, do we see a re-rating? And we all both agreed that yes, we are looking at a re-rating in IT. But having said that, now look at the facts. Okay, if you go back 10 years into history, probably only two IT names made it to the top 10 companies globally, which was Apple and Microsoft. If you look at it today, there's only two non-tech companies which make it to the top 10, which is, I think, Aramco and Berkshire. And I guess Berkshire, the bulk of his wealth is coming because of his Apple stake, which he acquired in 16 as such. So that's how it is. So it's the world which is honoring this and not as alone. And now look at the numbers. Okay, yesterday we were on a call with TCS, and they were throwing these figures. They said that the BFSI space, which is the largest contributor to Indian IT, there's only 8% of the spends go into digital today. Okay, and this is despite the fact that if you look into the future, you will realize that digital will be the only way forward. There'll be only digital currency. I mean, physical currency will not be there, and these banks have to change as such. So that is bound to move, and this is the biggest sector. The other sectors were in 2 and 3% range, which also need to change. I mean, you talk about media, healthcare, talk about telecom, all these sectors have to change going forward. So that spends will keep happening as such. And don't forget there's a 5G around the corner. And 5G is not only about telecom, it's about the way we will be living, the way we'll be buying things, the way we'll be working. It's all about that, IoTs and stuff like that. So that will again be a big booster for tech spend. So we are very clear that this is going to be a multi-year tailwind here. And probably, I mean, bulk of the re-rating is done. They're already at 30 times forward earnings, which was probably what they were a decade back or so. But despite, I mean, I think from here on the earnings will kick in already. I mean, the only guy who gives out a forward guidance, Infosys, has already upped it to around 18 odd percent, and that should go to 20 odd percent. So if you're talking about 20% top line kind of a growth, we're talking about mid 20s kind of a growth for the bottom line, which should be very exciting for these stocks as such, and that's what will prop it up, I suppose.
What else do you see scope of a re-rating, such as large as which played out in IT back in February when you spoke about it?
Where there's not much scope left now, Aisha, as such in the market today. Because frankly, I mean, I think the whole market has re-rated. I mean, you look at it on a global scale, if you compare it to the emerging market index, or even if you look at the global indices, we've fairly re-rated along the way as such. And I think, in fact, if anything, there are pockets of excesses which are happening now, basically in the FMCG space, mainly in the MNC FMCG space, where they're quoting at 70, 80 times forward earnings, which I don't think can be sustainable. In fact, there are other stocks also which are at 70, 80 times, but those are not sustainable valuations given the fact that there's no earnings growth happening. The earnings growth is at best early teens as such. So that is going to be a bit of an issue. So bulk of the re-rating done. In fact, the excesses which are there from here on, it will be pure earnings growth will kick in, and which is looking very good. I mean, if you look at the Nifty earnings growth, it's at 30% plus this year. Going into the next year, it's at around 18, 19% odd. So that should itself be enough for the market to move. And frankly, I mean, on a yearly basis, you're looking at a 14, 15% kind of growth in the indices, which should be good, and this kind of earnings growth should be able to support.
Okay. Hi, Mr. Irani. This is Mubina as well joining in. When you talk about absolute earnings from here on, there is still a case to be made for metals to do that. At least for Q2, perhaps from Q3, if the trend continues as we've been seeing for the last 2 to 3 weeks, then it may temper off from Q3 onwards. But do you think that given the fact that we've seen, and let's talk about ferrous only right now, that we've seen steel prices actually falling for the last 3 to 4 odd weeks, would you see that there is perhaps some hints of us having passed that peak steel price period?
So Mubina, good you asked me about the question on ferrous metals per se. The fact is that if you go into the analyst numbers, next year they're anyway seeing a drop in earnings, despite this year going to be a phenomenal year. In fact, the first quarter was a eye-opener. And in fact, when you mention about the steel prices going down, don't forget that even the input prices have gone down. I mean, the ore prices also are looking a bit tepid today as such. So that way, maybe the margins will be sustained per se. But also look at it this way, that of the exporting countries, I mean, there were hardly any, I mean, a handful, China, Korea, Japan, and Russia, right? These were the 4 major exporters. Within Europe, it was mainly they were exporting to each other. So let's leave out Europe per se as such. So out of that, China is already out. I mean, they're out as in they've reduced their exports per se. They're looking at controlling their production given the pollution levels, and also that fact that they've started importing coal from Australia, and now they're so that input has gone up for them also as such. So that way, their production values have moved up. I mean, their cost of production has moved up. So that way, if you see, looks like pretty exciting even today. Not exciting as in, but looks pretty decent even today. So we were very skeptical. In fact, when the rally started, we felt that it was more of these sound bites coming out of China per se, or the way US was printing dollars. And we were fairly skeptical here, but then we realized somewhere down the line that no, these are longer term issues. And the fact that production will not keep pace with the kind of demand which has kicked in, well, that looked exciting too. But now, having said that, also, auto numbers globally have come off. And that's mainly because, as we talked in the beginning, because of the semiconductor issues which are hitting the auto industry. So that may create a dampener for the time being. But on a longer term basis, I mean, rather medium term basis, you can never say in a commodity a longer term, but medium term, I think there is a healthy scope of the stocks continuing their journey upwards. Bulk of the return has been done, but all will depend on the next year numbers. If and when they're upgraded, they're right now at a massive discount to the current year numbers. So if that happens, I think there's again a up move remaining in the metal stocks.
Well, Dinshaw, really appreciate your time. So glad you could join us. Always look forward to our interactions.